All right, today we're going to be talking about a stock that I think will be my easiest 10x investment probably of my lifetime. And I don't think I've ever said those words on this YouTube channel before. So let that be a testament to my confidence when I make that statement. Before we get into this, there's one thing you need to know, and it's that I'm a contrarian investor. I see risk in what's popular in the stock market, and I see opportunity in what's unpopular in the stock market. And right now is such a unique time period when it comes to AI. I'm a believer in AI, but the companies in the stock market that are benefiting most, their stock prices are going up the most because of their tie-ins with AI, I believe actually benefit the least from AI's advancements. Most of those companies don't even make money, yet their stock prices are skyrocketing. This video today is going to be the first of probably 3 videos where I talk about companies that I believe have incredibly cheap valuations and that are directly positively impacted by the advancements in AI. So if you're new here or returning and not yet subscribed, be sure you subscribe down below. We're getting closer to 40,000 subscribers. Make sure you don't miss the next 2 videos in this little installment series, I guess you could call it. And also, if you want my buy and sell alerts, I alert all of my members every time I buy and sell a stock. You get extra access to my brain and my thinking, my macroeconomic analysis, members exclusive videos, all that good stuff. And if you don't find value in the membership, I have a 100% refund policy. Again, it's my confidence in my ability to provide you some sort of value. So if you want to join that, hit the join button located right next to the subscribe button or the Patreon link in the pinned comment. We just reached over 300 members in the membership. Incredible. I'm entirely self-funded and independent. So the fact you guys are watching this video, that means a lot to me. And special shout out to all those members. But without further ado, let's dive into this video. The company I'm talking about today is Fluence Energy. Now, I know there's probably a good chance you've never heard of this company before in your life. And that's because it's unpopular despite the valuation being extremely attractive. And I'll show you the numbers. I'll show you my thinking behind this. But keep this in the back of your mind throughout this entire video. This is a company that trades for $1.2 billion. That's the market cap of this company. Another thing that might scare you away is the fact that over the last month, the stock is down 50%. The funny thing is, before it fell 50%, I thought it was already a great buying opportunity. But man, ever since it fell 50%, I have been backing up the truck and loading up as many shares as I possibly can. I will likely be purchasing call options soon. And again, I'll notify the members when I do that. That's how optimistic I am about this company and the way the stock market is mispricing them. So what does Fluence Energy do? First of all, they are owned by the AES Corporation and Siemens, relatively big names in the United States of America and internationally. Together, those 2 companies own 44% of Fluence Energy. Fluence Energy is a part of the battery energy storage system market, aka BESS market. And this market is projected to grow at a 28.6% CAGR through 2034. Needless to say, the tailwinds are definitely at the back of this company. Part of what has scared investors away from Fluence Energy is Trump's second presidency. They think green energy is going to do bad under Trump's presidency, when in reality, if we go back and look at Trump's first presidency, green energy actually did better in the stock market than it did under Biden's presidency. Kind of an interesting note there. And we're going to go through this entire investor presentation today. But let me start with this because it ties directly in with Trump. Fluence Energy is the market leader in the battery energy storage system market or industry. And their competitive advantage is their domestic content leadership and their ability to provide a 100% non-Chinese product. They have battery module manufacturing in Utah, enclosure and DCPM manufacturing in Arizona, chiller and HVAC manufacturing in Illinois, yada, yada, yada. More manufacturing in Tennessee, South Carolina, and Georgia. They have zero reliance on China, which means that this company has a tremendous competitive advantage to other companies that are in this space or that are trying to play in this space. Why is that? Well, it's because if tariffs do impact this industry, It's going to be Fluence Energy that actually benefits from that because their offerings will be much more attractive to people looking to buy battery energy storage systems because, Fluence Energy is not, they don't have to eat that cost or try and pass on the extra cost of the tariff to their end consumer. Remember, all tariffs do is they change the math. They change the economic math between domestic production and importing goods from overseas. It changes that math, and that's why tariffs long-term actually help this company, which is very surprising to a lot of people. Now, I told you to remember this was a $1.2 billion company, so I'll start with this before we get into the investor presentation, so I kind of lied. Over the last 12 months, Fluence Energy has done $2.5 billion in revenue. Their quarterly revenue growth year over year was down 50%. And we'll get into that in just a little bit. That is not lost revenues. It's revenue that has been delayed. And the markets, I don't think they realize that. This company delivered $326 million of gross profit over the last 12 months and EBITDA of $15 million. So this is a profitable company that is trading for less than half of its trailing 12-month revenues. And with the battery energy storage system market growing at 28.6% CAGR, this is going to scale up quickly over the coming 5-ish years and going into 2034 and 2035. So over the next decade, I'll just say, their revenue numbers will approach $30 billion by the year 2035. And I'll show you my price target spreadsheet at the end of this video, but they're going to deliver hundreds of millions in profits to shareholders. So keep that in mind. The balance sheet is also healthy. This is not a company that is on the verge of bankruptcy, despite the stock recently trading like it is going bankrupt. They have $1.2 billion of liquidity on their balance sheet and less than $400 million of debt. I'll show you that too on the investor presentation. So let's just get into it. Get into the investor presentation here. Why is the stock down? The company lowered their fiscal year 2025 revenue guidance by $600 million. I was very disappointed to see this, and the markets were too, very clearly. They now expect fiscal year 2025 revenue of $3.1 billion to $3.7 billion, which would give you a $3.4 billion midpoint. And that's compared to the previous guidance of $3.6 to $4.4 billion or a $4 billion revenue midpoint. They say the $600 million reduction is due mostly to delays in the expected signing of contracts for 3 projects in the country of Australia. They had permitting issues that have now been resolved or are close to resolution, and they expect to sign these contracts later this year. This is where you get that they didn't lose revenues, they just have delayed revenues now. Now, that doesn't get rid of the problem. The management team completely whiffed when they issued this guidance at the end of last year. They failed to recognize the risks that were surrounding these projects in Australia. And as a result of that, there's the age-old saying that a bad management team can ruin a great company. We now have to question if we can trust the management team, if we can trust them. And that's a legitimate question now that they whiffed on their guidance for this year by $600 million. That's not a small whiff. That is not a small whiff. And that changed over the course of 3 months. They went from a $4 billion midpoint guidance to $3.4 billion midpoint guidance. Now, the positives here are that this midpoint revised guidance is approximately 85% covered under their current backlog, plus the revenue that they already recognized in Q1. That's versus an 80% coverage ratio at this same point last year. And this revised fiscal year guidance still represents 26% year-over-year growth from fiscal year 2024. Obviously, with the entire industry growing at 28.6%, we kind of want Fluence Energy's revenue growth to be 30% plus, ideally. And they do talk about how they think they're going to return to that next year and in the years that follow that. Moving up in the investor presentation here, you can see that they only did $187 million of revenue in the quarter. That was a big miss. But during the quarter, they also had an order intake number of $778 million. Order intake of $778 million. And their backlog at the end of last year was $5.1 billion, up $500 million during the quarter. Their current pipeline is $21.4 billion. Their annual recurring revenue is up to $106 million. This is high margin software revenues. And their total cash was $654 million. So there are a lot of positives here. And the management team they ruined the trust that the market had in their ability to guide numbers and guide this company. So they ruined the optics around this investment opportunity, and rightfully the stock price has fallen 50%. Now I think it's a tremendous buying opportunity, and the management team went out and did something that was very, very smart. Very, very smart. And this is representative of a management team that has their heads screwed on straight. They went out into the open markets and bought shares of their own company. Insider buying, and this just happened in the last few days. The CEO bought $150,000 worth of shares. The CFO bought $100,000 worth of shares, and they had a couple other directors, actually a few other directors that went out and bought shares as well. This is a very, very good omen for what the future of this company looks like. Just even out, if you don't want to look at the backlog, you don't want to look at the pipeline, you don't want to look at their guidance, the management team clearly has confidence in this business moving forward. And I do too. This was a great, great decision for them to go out and buy shares in the open market. And they bought shares for $6.50, $6.40. That's kind of the range I've been buying shares at. I think they're going to make out like bandits on those buys personally. This slide here shows you their current year backlog, which was $2.7 billion. So that's $2.7 billion that they expect to book in revenues this year alone. Again, companies trading for a $1.2 billion fuvaluation, actually less than $1 billion now, according to Yahoo Finance. That's crazy. I'll keep buying. And the future years backlog, they have $2.4 billion already in backlog that they will book in future years. And again, their total pipeline grew by 60% year over year and increased by nearly $500 million during the quarter. There's some very, very positive developments here. And I guess now would be the time to discuss it as well. In the company's 10Q, in their SEC filing, you'll see that their inventory numbers bumped up, and I'll try and zoom in a little bit more here. There you go. You can see it a little better. Their inventory numbers bumped up from $182 million to $543 million. In their conference call, they talked about how this inventory bump is for near-term projects. So I take that as near-term, meaning projects that will be executed in the next 12 months over the short term, over the near term. This will be inventory that goes to generating revenue at the company. The fact that it had a massive increase during the quarter is a very healthy signal. Now, that's not even it. I can show you how their deferred revenue numbers bumped up during the quarter by some $316 million. And I actually go to the statement of cash flows here. You'll see that here, $316 million right above my face cam. The management team also mentioned that this deferred revenue is revenue that they will recognize in the second quarter. So the Q1 results were less than desirable, but there are so many signals out there right now that their Q2 is going to be a massive bounce back. And I think another thing the markets don't realize is for better or worse, Fluence Energy's revenue profiles, it's mixed between 20% being recognized in the first half of fiscal years and 80% being in the back half of fiscal years. So they are a very Q3, Q4 heavy company. Hopefully over time, that lumpiness will disappear as they grow, and especially as they grow their annual recurring revenue streams and their services business. Hopefully that lumpiness will start to work itself out a little bit. But it's just another thing that I think the markets don't understand here. And you can go back and look at Q4 of last year and see that Q4 is historically very, very strong for this company. It's not just something they're blindly guiding to this year. There's evidence that this is true based on history. Now, this slide here kind of shows you their guidance revision again. They also anticipate that their gross margins, their gross profit margin is going to be lower than previously guided. It's going to be in the range of 10 to 12%. They say this is primarily as a result of competitive pressures. We'll get into that in a little bit too. And approximately a $10 million tariff impact that's going to be a one-time hit, short-term thing for the company. Here they discuss that this year they expect the revenue split to be 15% first half, 85% second half. So they expect negative adjusted EBITDA in the first half of the year, but positive adjusted EBITDA in the second half of the year. And here they say it. They expect revenue growth of 30% plus in fiscal year 2026 and beyond, starting from the updated fiscal year 2025 guidance. This slide shows why they've revised their adjusted EBITDA numbers or guidance lower. They expected a $75 million positive impact from those 3 Australian projects that were delayed, and they expected 12.5% gross margin on those projects. That's going to be a $75 million hit to adjusted EBITDA. And they also project a $50 million hit based on their lower gross margin guidance as a result of these large projects not being recognized with the higher gross margin. Their gross margin guidance went down for the year. And this also includes the $10 million tariff impact. Now, they also started talking about, and I think this is a very good thing as well, right-sizing their cost structure to align with their growth. So they're going to have a $30 million positive impact to adjusted EBITDA from cost reductions. I think that's a very smart thing to do right now as well. And again, I mentioned that the markets are kind of trading this company like it's going to go bankrupt. They are far from bankruptcy. They will never go bankrupt. I'm 100% confident when I make that statement. They have $1.1 billion of liquidity on their balance sheet, and they're entering profitability where they're going to consistently be profitable moving forward. And those profits are only going to grow as time goes on. Again, the stock is not trading like this is a very healthy company. And it really is a very healthy company despite management whiffing on their guidance numbers for the first quarter. The easiest way to put it is that this company has so many tailwinds at its back that all it takes is the management team executing, and they failed to execute in the last quarter. Now, I think it's the first scratch on this company's management team. I think they're going to get it corrected. Obviously, we'll have to look at the next quarterly report, see those numbers, but just based on the things we're seeing today and the things I'm going through, Q2 looks like it's going to be pretty strong for the company. Now, the last thing I want to get into before I show you my fair value spreadsheet is what Fluence Energy announced to kind of head on those competitive pressures that are putting negative pressure on their gross margin and their business. They announced a breakthrough technology. This was a couple days after their earnings report, and they released a press release that talks about it here. They unveiled SmartStack, a high-density AC-based energy storage platform with a breakthrough modular design. It has 30% higher energy density compared to other leading market solutions, which drives enhanced overall project economics. So density is basically how much power you can fit into a confined space. If energy density is increasing, it opens the door to projects that maybe were unavailable previously because of just simply constraints on the land that was available. But if you can pack more power into a smaller amount of space, it opens up even more revenue opportunity for the company. And they kind of talk about that in this press release. They say this density is approximately 30% higher than currently available systems. The platform enables more megawatt hour generation within existing project footprints, reducing costs and making previously constrained sites viable for storage project development. And then they mention how the modular design of a SmartStack enables a more agile and cost-effective supply chain localization strategy, allowing components to be sourced or manufactured regionally to optimize availability, cost, and compliance while enhancing resilience against geopolitical and logistical disruption. So very, very good product here that's 30% better than the current offerings out there. I'm sure that they do have patents that protect this, but other companies will find a way to kind of copy what they're doing here. But as long as Fluence keeps their foot on the gas and maintains that leadership position and the competitive advantage of the ability to provide products that are not reliant on China whatsoever, that's a huge competitive advantage for this company moving forward. So moving to my fair value spreadsheet, this is in the Discord server as well, so you can change your numbers if you don't like mine. I have decreased my revenue estimates just based on the management team's inability to guide properly previously. I will have no problem going back in and bumping these numbers up if the management team does turn things around and this was just a one-time blip, one-time oopsie. I'll have no issue coming back in and revising these numbers higher. I think the important note here, though, is that even despite my downwards revisions to my revenue numbers and overall profitability numbers, I still have the company in 2035 bringing almost $4 billion of net income to shareholders, which would be $19.29 of earnings per share. And based on just a simple forward price to earnings multiple of 20, this would give me a price target for Fluence Energy of $385 by 2035. Now, we talked about how right now this company trades for basically $1 billion on the stock market. In order for this company to 10x my investment, like I started this video off by saying, the market cap would have to climb to $10 billion. But when you look at these numbers, that looks like a very likely scenario here. When you have the industry growing like it is, the CAGR rate that it has, you have Fluence Energy's leadership position, their competitive advantages, the fact that in 2026, I have them delivering already $100 million of net income to shareholders, or 56 cents earnings per share. By 2026 or 2027, this could be a 10x of the share price. Now, the market can do whatever it wants in the short term. This is just how I value the company. There's always wild cards out there that you can't control as an investor, that there's black swan events, there's gray swan events out there that can happen. But bottom line, right now, I think the fair value for the company is around $30 per share, and it's trading for $7. $7, actually less than $7 today. And this is based on conservative price to earnings multiples and conservative price to sales multiples, given the growth rates that this company has and will have moving forward. This also assumes that over time, the company will dilute shareholders by 1% annually as a result of, RSUs and stock-based compensation. But over time, as the company delivers more income to shareholders, I think there's a good possibility that they're going to return capital to shareholders through share buybacks, which will reverse any of this dilution that takes place over time. So I don't know. Let me know if I'm missing anything down in the comments section below. I'm extremely confident in this investment. I'm going to continue to buy it, especially if it continues to trade for single digit share prices. That is so incredibly attractive to me right now. And again, this is a company that's going to benefit from all of the AI spend, because AI demands power, and our country is already at a power deficit. How do we fix that? Well, it's through battery energy storage systems, and it's through on-site energy production and storage. That's directly what Fluence Energy is involved with. Moving forward, I'll have my next couple of videos in this installment. I'll have a company that is AI on the fly, AI on the edge, where it really matters, where the real money is at. And I also will be talking about a warehouse robotics company that is benefiting from the AI trends and automating warehouses and automating lots of different stuff. So stay tuned for those videos, because I'm not quite as excited for those ones, but man, I am excited for those ones as well. But this opportunity with Fluence Energy is just, it's too good for me to pass up right now. With that, have a great rest of your day. Stay blessed. Keep 10 toes grinding your chin up. Peace out.